Here's a wild thought. A lot of retirees will actually finish their retirement with more money than they started with. And no, it's not because they're all secretly brilliant investors. It's because they're just too scared to spend the money they worked so hard to save. So, let's dive into why this happens and what it really means for you.
So, let me ask you something. What do you think is the single biggest financial risk when you retire? I bet for most of us, the first thing that comes to mind is running out of money. But what if that's not the whole picture?
What if the biggest risk is actually the complete opposite? The risk of not spending your money, of failing to enjoy the very retirement you spend decades saving for. It sounds kind of crazy, but it's an incredibly common problem.
Okay, so here's our game plan. We're going to unpack the spending paradox itself, define something called the consumption gap, look at the psychology behind why we're so afraid to spend, see what the actual numbers tell us, and then, most importantly, lay out a plan to help you spend with confidence.
All right, first up, the retirement spending paradox. This is this core, counterintuitive idea that so many people who did everything right, saved their whole lives, end up barely even touching their nest egg.
Yeah, you heard that right. Instead of drawing down their savings like they planned, a lot of retirees actually watch their accounts stay the same or even grow. And get this, research shows this happens even during awful market conditions, like the crash between 2000 and 2008. So this isn't about getting lucky in the market. It's about a deep, deep reluctance to actually spend the money.
And you know what? This phenomenon actually has an official name. Understanding it is really the key to solving this whole thing. It's called the consumption gap. Researchers writing in the Journal of Financial Planning coined the term consumption gap. Basically, it's the giant gulf between the lifestyle your portfolio could safely pay for and the lifestyle you actually live. And for a lot of people, that gap is just massive.
This story from a financial planner just nails the mindset perfectly. He's talking to a client who's already retired with $4 million in the bank. He tells the client he can easily afford a dream trip. And the client says, yes, but that money's for retirement. The planner had to gently say, but you are retired. That, right there, is the consumption gap in a nutshell.
So why does this even happen? I mean, what's going on in our heads that makes it so incredibly hard to flip that switch from save, save, save to, okay, now it's time to spend? Well, it really comes down to two big things. First, there's the saver's mindset. I mean, if you've spent 40 years telling yourself no and practicing delayed gratification, it feels fundamentally wrong to suddenly start spending freely. That habit is just wired into your brain. And second, there's this powerful fear of uncertainty. All those what-ifs can feel absolutely paralyzing. And look, this cloud of uncertainty is made up of totally legitimate fears. People worry. How long am I going to live? What if inflation goes through the roof? What if the market crashes right after I retire? These are valid questions, but they can get so overwhelming that they lead to some, well, pretty irrational decisions. I mean, there's a story about a couple in their mid-70s with $7 million in savings, plus a pension that covered all their bills, and they asked their advisor if they could afford a new front door. A front door! That's how deep this fear can run.
Okay, so we've talked about the emotional side of this whole thing. Now let's pivot to the logical solution, the cold, hard data. Because sometimes the numbers can give us the permission to spend that our own gut feelings just won't.
For this, let's turn to the work of a financial planning guru, Michael Kitces. He ran the numbers on a hypothetical $1 million portfolio over a 30-year retirement. He looked at two scenarios, a pretty optimistic one with good returns and low inflation, and then a more pessimistic one with lower returns and higher inflation. In both cases, the goal was simple. How much could you spend each year to end up with exactly $0 on day one of year 31?
So in the good scenario, scenario A, how much could you take out? The answer is a whopping 6.1%. That's $61,000 in the first year. Now think about that. That's way higher than the famous 4% rule everyone talks about. In fact, in this scenario, you wouldn't even start touching your original $1 million principal for the first 17 years.
Okay, but that was the optimistic case. What about the more pessimistic one? Well, even with lower returns on higher inflation, the safe withdrawal rate is still 4.9%. Again, that's almost a full percentage point higher than what most people think is safe. But honestly, this next part is the real mind-blower. Kitces looked at historical data all the way back to the 1870s for a retiree using that standard 4% withdrawal rate, and what he found was just stunning. It was incredibly rare to finish with less money than you started with. In fact, based on actual history, you are far more likely to end retirement with 5 times your starting wealth than you are to end up with less. Just let that sink in for a second.
So this data, it gives us a real foundation for a solution. The question is, how do we build a bridge from all that fear to actually spending with confidence? Well, it all comes down to having a real, deliberate plan.
See, the root of underspending is often just winging it, relying on your gut feeling. And when we do that, this psychological bias called loss aversion kicks in, and every dollar you spend feels like a painful loss. The only antidote to that is to stop relying on intuition and start using a concrete, data-driven plan. A great approach is something called a dynamic income strategy. Here's the gist of it. First, you stress test your plan. You run it against the worst market downturns in history to see how it holds up. Second, you build in some flexibility. You create simple rules for when to maybe trim spending just a little in down years, which ironically lets you spend more overall. Third, you can create spending buckets, setting aside some cash just for those downturns so you never have to sell when the market's low. That's a huge confidence booster. And finally, you just review the plan regularly to make sure you're staying on track.
All of this, the data, the strategies, it all leads to the most important question of all. And this is one that data can't answer for you. If you really, truly gave yourself permission to spend the money you saved, what would you actually do with it? Would you get on a plane to see your grandkids more often? Would you finally take that trip you've been talking about for 20 years? Maybe fix up the house, or help out a family member who needs it. Or maybe, and this might be the most important one, just live your day-to-day life without that constant nagging anxiety about money.
At the end of the day, money is just a tool. But underspending has real consequences. It leads to missed memories and unfulfilled dreams. You spent an entire lifetime building up your savings for a reason, for a purpose. The real challenge of retirement might just be giving yourself the permission to go out and finally live it.